The World Bank expects India's economy to contract 9.6% in FY21, and that is steeper than 3.2% shrinkage, which was projected back in June. Let's do a three-point analysis to find out what has made World Bank's forecast further bleak from here. 1. A grave situation. The World Bank has said that India is in a far graver situation than it was during the balance of payment crisis of the 1980s leading up to 1991. The World Bank said COVID-19 caught India as its economy was already slowing down and it was weakened by the financial sector problems already. It has also forecast that in its half-yearly South Asia focus update that South Asia as a region is set to plunge into the worst ever recession with a sharper than expected contraction of 7.7%. 2. What are the reasons behind the bleak forecast? Well, the impact of COVID-19 materialized against a backdrop of enduring fragility in the financial sector. Secondly, slowing overall growth. And thirdly, limited fiscal buffers. These were listed as the reasons by the World Bank as the key reasons behind the bleak forecast. The report highlighted that informal workers are not generally covered by social insurance and few have savings or access to finance as well. And the 3/4 of all workers in South Asia actually depend on informal employment, which is a big cause for concern currently. 3. Uncertainty overshadows outlook. Well, the World Bank has said that there is substantial uncertainty and that's related to the cause and duration of the pandemic. How long will it last? The speed at which households and firm behavior will actually adjust to the lifting of the lockdowns and a possible new round of counter-cyclical fiscal policy as well. Also, while the government has signaled that it is prepared to support the economy through fiscal measures, there is no clarity about the timing or the extent of the next round of stimulus. And on top of that, the big problem is that the formal sector has no coverage. The informal sector has no coverage. Now, there are no systems in place to support these people. So that's a concern. However, the report said that growth is expected to rebound to 5.4% in FY22, but mostly reflecting base effects, while potential output is expected to remain quite depressed in the medium term. Inflation also is expected to be around RBI's target range of say 4% in the near term. Now, the general government fiscal deficit is also projected to rise to above 12% in FY21 before improving gradually. Now, public debt is also expected to remain quite elevated at around 94%, and that is due to the gradual pace of recovery going forward. It further noted that while the policy interventions have preserved the normal functioning of the financial markets thus far, demand slowdown could lead to rising loan delinquencies and also risk aversion going forward.